It's not recording yet. Just a second. Okay, that's good. That's recording. All right, great. So yeah, we're going to be able to start.
Okay.
So today we have a special meeting, actually. So we're going to talk about real estate, right? We had also a meeting about real estate last week, but this one is really, it's going to be totally different. We're gonna basically with us today we have Jason and Martin that are working on a project. Basically, the company is called One Development Corporation, and they're gonna tell us about an investment opportunity. I don't want to say too much about it. I'm gonna let Jason and Martin talk. So if you guys can please introduce yourself and tell us about everything.
Okay, excellent. Thanks for the intro, Bryce. My name is Jason Ferreira. I'm a founder and CEO of One Development. We have Martin McDonnell. He is a part of a partnership that we have with Imbaka Corporation, which we'll get into as we go on. So I'm going to go ahead and start up the presentation.
So one thing, guys, during the presentation, if you have questions for Jason, you can either write them in the chat, raise your hand, or otherwise, I was going to have some time at the end. So if you guys have questions, you can just wait.
Yes. Yes. Okay. Can everyone see the presentation?
Yeah, that's good.
Okay, excellent. Okay, everyone, thanks for tuning in. Hope everyone had a good weekend, long weekend. So we are today going to talk about my company, One Development, where we've brought together a team of experts to transform the way property acquisition and how redevelopment is happening in Toronto. So what we do is we take dated houses and we transform them into uber modern homes. So our model is pretty simple. We buy older down market houses in prime GTA locations, we tear them down, and then we rebuild them for sale at or below market prices. So this is a forward-looking statement. This is just a general disclaimer that our business and financial planning could change, and there's no guarantees. So the problem. So what I found and why I started One Development is the problem in the Toronto housing market. So there's a few things happening here. Obviously there's a huge, there's a supply and demand issue, and buyers are being forced to choose price over livability, meaning that they're buying homes that they don't necessarily love, but are kind of forced into because they don't have a whole lot of options. So what you find within this target range that I'll go over is that new or rebuilds less than 2 million, are lacking style and design, in most cases poor workmanship. And these are the type of homes that are typically built by, the kind of fly by night or overnight investors. They're trying to, make a quick flip and sell the home, as quickly as possible to, make a quick profit. So you get, newer, or then you get the other side where you have new or rebuilds for less than 2 million. Like I said, they're lacking the style and workmanship. Then you have the other side of new rebuilds, which are priced over 2 million. Decent workmanship, but still lacking style. And so what we've created is something in the middle, like I said, where we're filling this gap in this demand for these uber modern homes between the 1.7 to $2 million range. So that's basically what we're doing. So with One Development, buyers don't have to make that kind of trade-off. It's our vision to change that. It's our vision to enter into the Toronto real estate market and start supplying the demand for these modern homes within those price ranges. So through our presentation, we're here to help you, the potential investor, make the right decision and show you how we're doing this differently in the Toronto real estate market. So what's our solution? So our solution is for One Development to build modern homes with design features that people are looking for, but at prices that attracts a larger number of people. And for those who are focused on facilities, especially now where the focus is on where we live. The pandemic has, certainly changed that. So, we're in a very good window of time here to meet these specific needs that people are looking for. The second solution that we're crossing here is that the difficulty for most Canadians to diversify their portfolios and invest in real estate. So obviously, as most of you know, real estate has gotten very expensive. And so the barrier to get in is very difficult now. It's, now you need, very significant large down payment money. Even to invest into, an investment property is gotten very, very expensive for most. Then there's the real estate investors who don't want the headaches of real estate management. So what we're really doing is solving two issues in that. One, we're supplying, these brand new Uber homes, modern homes to supply the market. Then we're also solving the issue of creating an opportunity for investors to get in on the market in a very creative and unique way. So our differentiation. So this is a very important part, and this is where we're doing things differently with One Development. The current marketplace isn't operating in this way, so I've really taken a lot of time to craft a really well-built organization. So why we're different? First off is my corporate experience. I've spent many years in corporate sales. It's trained me to think strategically, how to grow a business. I've learned how to develop key partnerships as well as deep knowledge in sourcing and leading teams. So on this front, there isn't a single area within the business management that I haven't played a role in. In the company I was with before, I played a major role in most departments. So combined with my experience in home renovations, my corporate sales experience, I'm certainly well positioned to take on the responsibilities needed to grow this business. The other key area is going to be financing. We work with the best non-bank lending. They also work with the best and most qualified companies. For example, in order for us to qualify, like a real bank, our lenders will, conduct an in-depth lending analysis that ensures that our target properties achieve intended ROI. So before they approve anything and loan us any type of money, they do their own due diligence to secure the investment with us. So this is really important because it ensures that we're finding the right projects together. So we're developing a really strong partnership, with our lenders to make sure that we're successful. The key to our success, is dependent on their success as well. So the design and construction management, same here, very important. We only work with the best. We've strategically selected the right partnerships for each project. So again, for example, we conduct a property analysis between our design firms and realtors. So together, we're ensuring projects are suitable for permitting and market profitability. We, of course, contract, expert trades, and they're going to execute on our design plans. And we're also in the midst of bringing on an expert level construction project manager. So that's a CPM who's going to be our boots on the ground, ensuring we're meeting deadlines, managing budgets, and providing seamless execution through the entire design and construction process. So Embaka Corporation, a very key component to our success. So Martin McDonnell, he's with Embaka Corporation and on the webinar. So I'll let you, Martin, talk a little bit about Embaka and what you guys do.
Yeah, Embaka Corporation is a company that helps entrepreneurs build and grow their businesses. We've worked with Jason in One Development Corporation in terms of strategy, their business plan, and the financial projections. Also, we're doing their accounting and financing as well. But we work kind of very closely with Jason on all aspects of the business. I just want to say that the president of Embaka Corporation, Malat Tafari, she really wanted to be a part of this tonight. Unfortunately, she had another previous engagement and wasn't able to make it. Jason, back to you.
Okay. Yeah. So again, it's this unique combination of support that we know will no doubt ensure our success. So make no mistake, we are working with the best and most experienced people available to us. That sees us paving our way to becoming an industry leader in the redevelopment space. So our business model, so in tandem with our lenders, our design and build firms, and we selectively acquire a project site for on average around $950,000 to $1 million. Again, this is dependent on market conditions, but today this is sort of the target price that we're working within in the areas that we're targeting. We then secure our building permits. From permit approval, we immediately move to construction, which takes approximately 10 to 11 months. And this is on a 25 square foot home at a cost of $225 per square foot. Once we've reached 90% completion, we then place the home for market sale with a targeted sale price of $1.89 to $2 million. Again, these are prices that are based on today. Again, you know, depending on where the market is, you know, pre-purchase and post-sale is, you know, determined at that time. But based on the information we have today, these are pretty solid figures. So as we progress, of course, we want to, you know, fine-tune our costs and improve our profit margins. So, you know, over time, we'll evaluate ways in which we can, you know, reduce our costs, whether that be through materials, trades, etc. So our target goal, you know, after a few years is to bring our per square footage cost down to $205 per square feet. So then this again reduces our costs and starts to maximize our profit margins. So our timeline. So based on our business model, the timeline to acquire our first project is summer of 2021. So just a few months away. The dates could change depending on market conditions, you know, again, you know, depending on availability or perhaps say project delays, but we're pretty certain we can achieve these milestones to get us to the next level, which is to get up to 26 construction starts and 22 home sales over the next 7 years based on our projections. So the plan from there, you know, again, we're operating as a real developer. You know, we're entering in the market through these one-off type projects, but our goal over time, you know, is to get into the much larger, more profitable projects for ourselves and, you know, and of course our investors. So we really want to, you know, grow this company and take things to the next level. And so based on our, you know, our business model and our timeline, we're certainly, you know, positioned to achieve that. So our financial forecast. So this is a graph we did just to give you a kind of picture, you know, of what this, you know, our projected sales are going to look like over the next 7 years. So the financial forecast is represented by this graph with time in months on the horizontal x-axis and covers the 7-year of our business plan. The vertical y-axis is millions of dollars. The blue line is cash. The orange line is cash plus inventory less debt. And that is the line that I really want you to concentrate on because this is where, you know, things really start to take off in terms of our profitability. Cash plus inventory represents the assets of the company. Debt represents the liabilities. So cash plus inventory less debt is assets minus liabilities. And this is the same as the shareholders' equity or the owner's interest in the company. Following the first couple of projects or builds, the shareholders' equity shows strong, consistent growth over time. So initially, we will build and sell one property at a time, moving to a new build every 3 months from 2023, moving to every 2 months in the final 2 years of the 7-year projection.
So, sorry, Jason, to interrupt you.
Yep.
Can you just say basically how did you come with that prediction, just to make sure that, because yeah, basically, and also you, if I'm looking at the chart, it shows that during the first 4 years, basically, the company is not going to be profitable. Is it what the graph is showing or not?
Yeah, Martin, maybe you want to take this question, Martin. I know you like answering these ones, so I'll let you take that one.
Yeah, we've you know, we're doing in the first 2 years. This is showing 7 years of operation, and in the first 2 years we do 2 builds. You know, so we start off kind of slowly, and you know, we built in a lot of contingency on the first 2 builds. But you know, starting off in years 3 and 4, you know, we moved basically to 1 build every 3 months, and then in the last 2 years we moved to a build every 2 months, so six projects a year. So you know, after the first couple of years, we start showing positive, you know, equity growth, cash plus inventory less debt, you know, which is a representation of our balance sheet. So we show strong and consistent growth from that point on. So yeah, no, it's we're not profitable from day one, but you know, we are confident that you know, it will be achieved over time. Our break even, by the way, is 1 project a year. So if you look at our fixed costs, they're about $400,000 roughly per year. And our profit on a home, you know, once we get fully staffed, is about $400,000 per home. So basically, our break even is one project, which takes a year to do. So we fairly rapidly scale up to 4 projects a year and then 6 projects a year. So that's why we have pretty strong and consistent growth over time. And when we get to the offer section of this presentation, we'll talk more about return on equity and things like that. So we'll get to that in a minute. Bryce, does that answer your question?
Yeah, that's good. Thank you very much.
Okay. Jason?
Okay, so our team, so we already touched on some of those areas. So our team is where the heart of our operations are at. I, of course, will be steering the ship. For design and construction, we'll be putting out bids to our pre-selected firms who specialize in modern design and construction. And Baca, as I mentioned earlier, is there to assist our growth. Both Martin and Mallette bring many years in financial planning, and will help us to analyze financial positions, market trends and strategies, improve cash flow, profits, and accelerate growth. So, the financial screen that we went through, that was something that both Mallette and Martin, put together. And so we're constantly evaluating, our planning and looking at ways that we can improve. And so Mbaka is really going to be supporting us in that area. Monique Pawlik, who will assist in sales and marketing initiatives. Her focus is in SEO, marketing, and branding. And as I touched earlier, lastly, we're in the process of hiring a high-level and experienced CPM who will eventually lead a team of CPMs as a number of projects increase over the years. So, as we talked about, once we get to year 3, we're going to be doing multiple, projects at a time. At that point, we would need, more project managers to, monitor and take care of our projects. So here's the offering. So the best part. So we're offering a preferred shares at $1 per share with a 10% annual dividend paid quarterly. The minimum investment is $500. Of course, you can invest more. For investments of $2,500 or above, you're also eligible to utilize, your pre-existing TFSA or RSP. So it's a great offer. A huge advantage of our offering is that at any time you can redeem your shares after 3 years, so you're not locked in. And Martin will talk. I think, Martin, you want to add a little bit to that as we go on. And then alternatively, at any time you can convert your preferred shares to common shares, and that's going to be at a 38% discount. So I'll let Martin add to that area.
Yeah, thanks, Jason. One of the really interesting and unique things about our offer is that when you compare that to most companies that go to crowdfunding to get money, investors buy common shares. So they're buying common shares of the company. And your potential payoff there is many years down the road before you realize any kind of a return on the investment. So we recognize the fact that we're a startup company. We haven't done our first project yet, although as Jason said, we'll be starting our first project this summer. So we could be viewed as fairly risky investment. So we came up with the idea of preferred shares, basically to make it easier to make a decision to invest. So what are preferred shares? Preferred shares are really like debt. Basically, you're lending the company money, and then you're being paid a dividend. It's equivalent to an interest rate of 10% a year. So if you invested, $10,000 in one development corporation, you would get paid $1,000 per year. And that would be paid out not once per year, but every quarter. So $250 every quarter. And then after 3 years of enjoying that 10% dividend, you could, if you want your 10,000 back or whatever your investment was, you could get it all back. Or at any time, you can convert your common shares, your preferred shares to common shares. So we're going to be providing, quarterly financial reports to you, so you can see how well we are executing our plans and how well we're doing. And if you see that indeed we're doing very, very well, which we fully expect we will do, then you can decide to convert your preferred shares to common shares. And for every preferred share you have, you will get 3 common shares. So if your initial investment was, say, $1,000, and so you have 1,000 preferred shares, you could convert those to 3,000 common shares. Or you don't have to convert them all. You don't have to convert any. You never have to convert. It's just an option you have. You can convert half of them or all of them, whatever you want to do, or none of them, in fact. And the thing about common shares is that, by the time we get up to 6 builds a year, we're showing a return on equity greater than 70% annually. So, assuming we can execute our plans, the potential with common shares is, a return on equity that's greater than 70% a year. Now, obviously, that would be realized through paying dividends on the common shares, or, if we do an IPO or whatever in the future, that would give you the liquidity. So kind of in a nutshell, the preferred share approach is a way to get involved, make 10% on your investment per year, paid out quarterly, which is really interesting, and then have the opportunity down the road, once you can see that we are in fact doing extremely well, convert them to common shares and make potentially even greater returns. So that's really kind of all of it in a nutshell. Jason?
Yeah, thanks, Martin. So yeah, to add to what Martin just mentioned, is we try to make this as flexible as possible. Again, we want to get people's interest, and so by offering the preferred share, it gives you the option to say, okay, let's see what these guys are all about. I'll take my 10%, and then after a few years, we have our shareholder meetings. We're able to we release our annual financials, and the people can say, hey, yeah, these guys are living up to what they told us a year ago or 2 years ago. I like what they're doing. They're making money, so now I want to convert my preferred shares to common shares. So it's a great opportunity for investors to really sit back and wait and see what happens, and then decide how far they want to go with this. So just to add again to what Martin said, so we're aiming to achieve a return equity of at least 70%, which we think is fantastic. It's unlikely to find anything like this in the stock market. To date, we've already raised $550,000. We're now seeking $750,000 through Equivesto. Use of proceeds: 100% of the funds raised will be used for the mortgage and construction loan down payment. So so we'll be self-sustaining by 2023, when additional funds to support the concurrent property development will be raised. So right now we're in a position where we could start, but we're looking to raise more funds through the Equivesto equity campaign. So to wrap this up, 5 reasons to invest. So number 1, our offering, I think, is the most valuable piece in all of this. It's very strong. Again, preferred shares with 10% dividend for 3 years, with the option to convert to common shares at any time. It offers a portfolio diversification with regular returns on investment that outperforms current bonds and bank savings. It's TFSA eligible, TFSA and RSP eligible, so you can invest a minimum of $2,500 or more. So the synergies: we're teaming with experts on all levels. We have all the right pieces for success. High-level strategies. Our close partnership with Embaka will most certainly enable us to achieve all of our goals. Analysis and surveys. So again, we partner with expert design firms, lenders, realtors to ensure we're selecting the right projects. Oh, a little too further ahead. And then the 5th piece is the investment. Again, we've developed a strong investment opportunity into the Toronto real estate market, and this gives you an ability to get in without having to deal with any of the hassles, and there's no fees or anything like that to invest with Equivesto. So again, thank you everyone for listening in. That's it for our presentation. And all of this really starts with one. Our game plan throughout this whole thing is to start through the development process by acquiring one single project, and then over the years we get into this build-sell cycle that sees us growing and evolving into a much larger development company, and getting into much larger projects across the GTA and even Canada. So thank you for your time and for listening. And I guess, Bryce, we can open up for questions now.
Yeah, that's good. There is actually one question from Jacqueline right now. So Jason, if you're able to see the chat, There is a question about bone structure homes.
Okay.
It looks like basically looking at what you're building, they look a bit similar. So
Right.
are they involved or?
Yeah, no. So what we're doing, what bone structure is they're prefabricated homes, and so their design is very modern style. So competitive or comparable to our design. We're just using the traditional means of rebuilding. So we're working from pre-existing sites. So there may already be a foundation there, and then we can kind of reframe and rebuild the home into these complete and finished modern homes.
Mhm. Okay, I see. I have one question for you. So just knowing that, like looking at the real estate market in Toronto, we know that it's hard to buy, right? So
Yes.
you always have to pay more if you want to purchase a property. So I would like to know basically how does that affect your calculations? Because just knowing that, for instance, you need a certain amount for the first project, what happens if you go over that amount to purchase? Is it possible, or you're going to look for another opportunity, or yeah, how
Yeah.
are you going to deal with that?
Yeah, so the way we're going about this is, again, we have pre-selected locations and streets and areas that we know are marketable for resale. So that's number
Mhm.
one. Then again, as I went through the business model, again, we're kind of targeting certain price points. So depending on, market conditions, it could be up, it could be less. I mean, right now, obviously, the market is very hot. It's unlikely that prices are going to go down. So, worst case, I think, within the next year or two, we'll probably see prices sort of stabilize or just kind of just sort of float. So I think we're in a good position to acquire a property at this point. Yeah, there is a situation where we can get into multiple bid type offers, but there's also a lot of off-market opportunities, and those are the type of opportunities that we're really going to focus on. And so us being a company, we're going to target those streets and those locations. We're going to target those specific homeowners. We've developed a very strategic offering that we can work with, homeowners and, maybe go through like a private type sale. We also have, realtors that are kind of doing these off-market type deals. They know when stuff's coming up. So we've really developed a strategic approach on how to, get these homes within the price points that we need to make this profitable. And so that's the first one. The second one is again, now this is where we've really come up with a strategic plan in terms of how we manage our costs and so on. And so I'll let Martin talk a little bit about the details around some of the specifics that we've put into our business modeling should the market change, should there be a market correction, for example. There's other areas that we're obviously monitoring now. One is materials, for example. If you're following what's going on in the home construction, lumber has gone through the roof because of a shortage supply. So things like that we're always evaluating, and we've built a lot of these things into our financials, into our costs. So I'll let Martin, touch on those points.
Sure. Thanks, Jason. Just before I do that, I just wanted to mention that we're concentrating our efforts in terms of buying homes in the East York area, kind of north and south of the Danforth, and we've identified homes and aging homes in this region, that we could buy between $800,000 and $1 million. So that's kind of the target, range that we're going to buy them. And then, as Jason described, we're going to renovate them and sell them for, roughly $2 million, or in some cases, perhaps a bit more. But in terms of risk mitigation, I mean, there are a lot. In terms of risks, there are quite a few obvious risks. I mean, right now we have low interest rates, but the interest rates over time could increase, which makes it more difficult for home buyers to, to buy a home, to afford it. And also the price. I mean, there's a lot of speculation in the media. Is the price has been going up and up and up? Does that continue, or does that crash, or whatever? So we've done a few things. One of the things we've built into our projections, our financial projections, is an 8% price correction in this coming year. So we're predicting the price of the homes will drop by 8%. Most people aren't predicting that, but just to be on the safe and conservative side, we've built that into our projections. Another thing we've done is also there is a Canadian Revenue Agency rule that says that if you buy a home and renovate it and then sell it, well, if your renovations exceed more than 90% of the floor space, meaning you've renovated more than 90% of the home, you effectively have to sell it as a new home and charge HST, and that's just CRA. So we've assumed and built into our projections that we're going to be paying that HST for every project, but we're not asking the customer to give it to us. We're basically eating it or paying for it ourselves. So we're going to be remitting the 15% to the government. We built that into the projections, which obviously hurts our cash flow. However, we expect that in most cases, if not all cases, we'll be able to build these homes and come under the 90% requirement, meaning we won't renovate more than 90%. We won't be subject to HST. So, it just means that we'll have that much more cash that we're currently not modeling, but we're expecting to have that kind of windfall on every project by avoiding HST. So it's another way we built a kind of contingency into our projections, and hopefully we're not just looking to meet our projections, we're looking to exceed them by a considerable amount, and obviously that will be good for investors. Jason?
Yeah, that pretty much answers that, Martin. So yeah, again, I would encourage anyone, once they've signed up on the Equivesto website, you can get access to our business plan and our financials. And so when you kind of go through the details of the financials, you'll see the specifics around all of that. So I think that's very important for anyone wondering, well, how are you going to mitigate these types of economic or market corrections or changes? And so through our in-depth strategic planning, we've created enough of a buffer in there to really cover our ass basically, and make sure that we're profitable and we're not in a situation where we're losing money.
Okay, that's good. There is 2 questions. We're going to answer that really quick because we're going to have to end the meeting. There is one question from Jacqueline about energy efficiency. Is there anything related to that with the house that you're building?
Yeah, so because of the design of the homes, we're obviously using, high-grade materials. Obviously, the net zero homes is a pretty big thing nowadays, and so through windows, the insulation, the types of insulation that exists now, there's a lot of materials that we can use that are above and beyond code. So those are things that we're going to look into as we progress. Obviously, we have to keep our costs under consideration. The net zero stuff is still, kind of borderline over our, costs. But, we know that those are marketable areas of a build that people are looking for. That's what the consumers want. There's all these green initiatives that are happening, obviously, across the board. And, we're always, looking at ways in which we can improve. So we'll certainly, over time, start to integrate and add in areas of our build to, meet this sort of net zero type standard.
Okay, that's good. Other question from Monica. Just on average, how much time will it take to complete a home?
Yeah, so basically the big part of all of this is the permitting. And so and I really want to point that out because that's an area of the build process that a lot of small investors miss. And so we partner with specific companies who know, and this is what I meant earlier by a property analysis. So a property analysis basically is they evaluate the streets, the homes, and what would be suitable or acceptable by the city for you to build. So we're able to mitigate that process and turn things around much quicker. So on average, our time to, from acquisition of the property to permitting is about 3 months. And then we add in another 10 to 11 months of building. So on average, from acquisition to project sale, we're about 15 months. So over time, of course, we're going to look at ways that we can improve. We can, speed up the construction process, create efficiencies to improve our permitting process, et cetera. So again, we're working with industry professionals to achieve all of that.
Well, thank you very much, Jason.